Something has changed in silver, not slowly, not gradually, but quietly and all at once. For decades, the metal went nowhere. It surged, collapsed, and then disappeared back into the same narrow box it had lived in for half a century. Every rally failed. Every breakout faded. Investors learned to stop expecting much. Michael Oliver believes that era has ended. His work suggests silver is no longer behaving like a market trying to rise, but like one that has already broken free and is now accelerating. Based on long-term momentum structures and historical precedents that appear only at major inflection points, Oliver believes silver could move into the $200 to $500 range by the second quarter of the year, not over many years, not over cycles, but within months, as the metal transitions into what he calls a new pricing reality. What makes this outlook particularly notable is that it does not rely on speculation, sentiment, or short-term price action. Oliver's work focuses on structural behavior, how markets behave after spending decades trapped in long consolidation ranges, and what typically occurs once those ceilings are finally removed. In his view, silver has only recently escaped a half-century valuation box, while gold broke free from its own decades ago. That imbalance, he argues, is now beginning to correct. At the same time, Oliver is watching signals that historically appear only during genuine precious metals bull markets, periods when gold establishes leadership, monetary confidence weakens, and silver begins to outperform dramatically on a relative basis. With gold expected to run considerably higher into 2026, Oliver believes the conditions are forming for silver to do what it has always done in such environments: move faster, further, and far more violently than most expect. In this video, we're going to walk through Michael Oliver's framework in detail, the historical parallels he draws, the signals he's monitoring, and why he believes the next phase in silver may unfold far more quickly than investors are accustomed to. If you value deep macro analysis and want to stay ahead of what could become one of the defining investment themes of 2026, make sure to like the video, subscribe to the channel, and stay with us through the full discussion. We appreciate the support and hope you enjoy the video.
I think what's happening in silver is different than what's going to happen in gold. I think silver is in a major process of decades of catching up to gold in terms of valuation. We're in a bull trend on silver. Everybody sees it. When you look at daily charts of this, you get spooked, like, oh, I got to take profits. This can't keep going, which is stand back and look at a bigger picture and you should get a different view. But in that 50-year, half a century range of price, you went from $4 to 50 to $4 to 50, so you get a $45 range, okay, roughly. Mm-hmm. And, if you do the simple arithmetic silliness of measuring the dimension of the range and say, well, I'll add that to the top of the range, that says, hey, you're in a target area, right? It's, $45 range, add 45 to 50, and you end up with something in the mid-90s. Let's call it short of 100. Okay. So people looking at that think, oh, well, this got to be the end of the move. We've done a lot of studies, both momentum, spread relationships, relative performance relationships, and also what's happened in some other markets, rarely, but still has happened. And copper, for example, also this is true with lead, a very exciting metal. They were stuck in a range for multiple decades. Back in the 80s, 70s, 80s, 90s, 2000, and in 2005 there, you can see there's a cluster of 2004 and 5, but it was later in 2005 that you burst through the top of that basically $1.50 peak that had prevailed for decades. And in a matter, these are monthly, right? Monthly candles. Yeah.
Yep.
So in a matter of a couple of quarters, went up to over $4. Bam. Okay. Yep. And by the way, it did it on its own. If you look, for example, at another base metal like lead, it didn't do that then. It did it a couple years later, the same thing in lead. And this wasn't associated, for example, with a silver gold explosion of that nature either. This was copper on its own. It just said, hey, I'm out of here. That old reality is not true anymore. I'm underpriced. And in order to get to maybe a more proper pricing fit with the new realities of copper, let's say, it didn't do it incrementally. If you weren't there, you missed it. Bam, gone. Okay. And then you lived, you'll see, oh yeah, it was a big sell-off after that. But look at the range that prevailed after that for decades. either side of $3, let's say. So a new reality. Well, how come silver, during all this time you're looking at here, was contained within its half-century box? It's like copper. If it were still at $1.50, all the way over to the right of your screen, it'd be like, well, why is it still down there? Okay, why is silver still down there? Gold isn't. If you look at where it peaked in 1980, we blew that out in 2011, big time. Now we've blown out that high big time. And yet silver only just recently has taken out its 50-year range. I'm not going to get involved in the rationale why that may have occurred, but it was an error. Markets make mistakes. They're not rational all the time. And in the case of silver, it's been irrational in terms of being suppressed too long at an unreal price level, especially when you look at its new reality of industrial demand, for example. Forget the monetary aspect, which too many people are forgetting, by the way. But industrial demand has outpaced supply for over 5 years now. And they're not, despite the price rise, they're not increasing production because most of the silver does not come from silver miners. It comes from base metal miners who, in which case the silver they produce is really a minority issue for them in terms of their profits. So they're not extremely motivated by something that's 2% of their output, let's say, going vertical. So it's in a very unique industrial supply-demand awkward position, which it's starting to correct quickly. But when you look at silver instead of on this arithmetic or point scale, dollar scale chart, and you put it on a logarithmic scale, ratio scale, going back, again to the 1970s, let's say, and you take the dimension of that range from those, $4 lows to $50 highs, that's a 10-fold move from range bottom to range top, range bottom to range top, 10-fold. Okay. Apply 10-fold to $50 to match the dimension of that range as a swing objective. You're talking $500.
Yep, okay. North of 500.
Yeah, and a lot of people know that. Eric Sprott, for example, I've heard him explain that if you just do a money analysis of silver price using M2 as your measure of degradation of the buying power of the dollar, silver should be a couple $100 easily. And maybe even higher if you go against the 1980 high. Yeah, you can see what I mean? Yeah, there you go. It's just underpriced, and it's like copper, like lead did in 2006-07, a couple years after that copper chart went crazy. It went vertical in several quarters. It didn't arm wrestle its way higher, exploded. Silver's in that position now. I think silver's like a surfer on the waves, but everybody's focused right now on the supply demand of the industrial aspect of silver. And they're not so much focused on it as a monetary metal, failing to recognize the history that just the same as gold, it's been money for man going back thousands of years, and at much higher valuations. So, for instance, if silver breaks out of the price range that it had for 50 years, which it's now done, why shouldn't silver's relationship to gold as a percent of its price, let's say, divide an ounce of silver and an ounce of gold, which is now like 2%, was 1% early this year, by the way, ounce of silver into gold. But if you go back to the 79-80 bull trend in silver, or the 2010-11 latter part of that bull trend, silver to gold was over 3% in 2011 of an ounce of gold. And it was up 6.5% of an ounce of gold back in the 1980 period. So what if this time, not only does price go up and challenge the highs of the prior decades and take them out, which it's already done, and maybe do the multiple gain we talked about in terms of ratio scale, why shouldn't the spread go up and at least challenge or perhaps even take out those dual highs of the past 50 years?
Picking up from Oliver's analysis, the central point is not simply that silver is rising, but that it has only just begun correcting a valuation error that persisted for decades. While gold has repeatedly established new highs and reset its long-term price structure, silver remained trapped inside a 50-year range, despite profound changes in monetary conditions, industrial usage, and global debt dynamics. Oliver's argument is that this disconnect was never sustainable. What follows from that is the next layer of his work. how silver behaves once it begins outperforming gold on a relative basis. That relationship, more than the price itself, has historically been the trigger for silver's most aggressive advances. And it is that spread dynamic which forms the foundation of his second and more consequential thesis.
But gold, prior bull markets, the last 50 years have been eightfold gains from bear market low to bull market high. 1976, corrective low just above 100, 850 by 1980. Then over a more protracted period of time from 2001 to 2011, eightfold gain in silver, bear low to bull high. Our bear low was 1,050. I mean, we'd have to be $8,500 just to do the same thing again that we've done twice before. It's like ho hum, gold did it again. 8,500. Well, if you take 8,500 and figure out what 3+% of that is, or 6.5% of that, your jaw will drop. And I'm not sure at all. In fact, I don't think it will. I don't think gold's going to produce.
What was it, 3.5%? 3.5%, is that what you said?
Yeah, 3.5% of 8,500. You tell me what it is.
$300 silver.
Yeah, okay. And then 6.5%. Back in the 70s and 80s. So
like 500.
Okay, you get the point. Okay, yeah. Meaning the logarithmic scale swing objective of silver instead of the $45 dimension is a tenfold dimension. Mm-hmm. That sort of fits with the assumption that, hey, maybe these spreads are going to actually challenge or take out the highs we've seen in the last 50 years. Not just silver price catch up to reality, but its ratio to gold to catch up to reality. Or in our case, we don't use ratio, we use percent. Think about it. Is it unreal? Does it make sense? Therefore, if that makes sense, then $90-something silver is still dirt cheap.
Is this the last time we'll be able to buy silver at 2 digits?
Here's what I says. The reason silver, first off, back in June, silver approached for the third time dual ceilings it had at $35. Late 24, early 25, silver peaked just above $35 twice. So, quote, a double top, right? Okay. Mm-hmm. And then it got bagged down into April, then turned up again. And by June, it was headed back toward that $35 potential triple top breakout, okay, if you're a price guy. Momentum said when it went up above 34 and even approached 35, you're gone. You're going to explode. And sure enough, we did. And we argued then that based on silver's momentum of its price, it was going into an acceleration phase. It didn't take long to get back to 50, okay. But then something else happened. And it wasn't silver being in a bull trend. Silver's been in a bull trend for a while, just like in 79 to 80 when it exploded in the final months of that move. It had already been in a bull trend for a while. Mm-hmm. Same in 2011 when it exploded to 50. It had already been in a bull trend for years. Something happened late in that move that caused the explosive phase. And what it was the our spread relationship versus gold. In each case, I think it was summer of 79, well before that explosion to 50. And in September of 2010, before it launched, it was in the $20 range and shot up to 50. The spread of silver versus gold broke through a ceiling. You plot the monthly close of silver divided into gold and just plot that chart every month. And what you'd end up with, there was a technical ceiling on the spread. We've had it in our reports many times. And it broke out above it. And when it did, that's when the whoosh occurred. And in each of those cases, just like in that copper explosion we showed, the move came and went in a couple quarters. I'm not going to get specific, 5 months, 7 months, maybe 8, okay? But let's call it at least a couple quarters, but very rapidly. Well, our breakout occurred in November, okay? The clock started, therefore, in December. If you ballpark it and say, okay, silver's going to go berserk versus gold and in price for the next couple quarters. So let's say sometime mid-year this year, silver will probably have done much of what it's going to do. And that doesn't mean when it's over, you collapse. No, just go to it, get to its new reality. Mm-hmm. The spread says so. The history of those prior events, like happened to copper, happened to lead, what happens to gold, it takes out the old highs and goes ape, okay? Silver is likely in the next starting with December as month 1, 2, 3, you get it somewhere in the second quarter, thereabouts, I'm expecting silver to be at very high price levels. At least 200, probably more like 300 to 500. Okay. Now,
second quarter of this year?
Yeah. In other words, the verticality's only begun. Okay. And again, that would merely be replicating what that copper chart did, or what a lead chart did, et cetera. So you want to be there. And the spread just broke out over a multi-year ceiling. So it's just begun in terms of that relative performance signal. And whenever it does that, there's a gusher. Both in net price of gold goes up steeper and silver goes up far steeper because the spread broke out. Silver's unleashed, going to catch up to gold. Maybe it'll go to 6% of gold. I don't know, 3% at least. But it's likely to be compressed on the clock. Now, in each of those cases, we microanalyzed those final surges, 79 to 80, September 2010, April 2011, where silver went up double and a half or quadrupled, et cetera. In the middle of those moves, roughly, on the clock now, middle of the clock of those couple quarter moves, there was what you could call a correction or a stumble, or at least a pause. In 79, prior to getting to the January 1980 high, there was not a reversal on a monthly price chart, but there was a pause such that you wasted like 6 weeks in that final surge. You see the little red candle you got there on the monthly?
Yep.
No, the one before you get to the top. That one, no,
this one?
that little guy. Yeah. Okay, so you can see that in October, November, December, there was some lateral action in each of those months where you could have bought and sold it at the same price, meaning there was a pause in the middle of that explosion, which obviously the candle before that was a huge up green candle, and it was followed by what? Another explosion. Similar thing happened in 2010 and 11, if you can move over to that. Again, that's the kind of pause that will confuse people because they'll think, oh, that's the top. Okay, go to 2010 and 11. Okay, there.
Oh,
see that red
one?
candle there? That was a reversal month. In fact, the intra-month high that month was higher than the prior month, and you closed down. So technicians would say, oh, that was a key reversal month, right? Okay. It didn't follow through at all the next month, and it blew your head off. Okay. So again, about in the middle of the clock of that couple quarter explosion, there was a stumble point that no doubt will fool people. So I'm betting probably sometime either late this quarter or early next, there could be a stumble in silver at much higher levels, perhaps, that creates that sense of, oh God, it's over. False sense.
Michael Oliver's broader message is ultimately one of structural repricing rather than speculative excess. His work suggests that silver is not moving higher because of excitement or momentum chasing, but because its historical undervaluation is no longer compatible with present-day realities. When a market spends half a century compressed inside a fixed range, the eventual release is rarely gradual. History shows it tends to be abrupt, emotional, and time-compressed. A key element of Oliver's outlook is the behavior of silver relative to gold. During prior precious metals bull markets, silver did not simply rise alongside gold. It surged once the spread between the two broke through long-standing ceilings. In both the late 1970s and the 2010 to 2011 cycle, that breakout preceded a violent acceleration phase lasting only a few quarters. Oliver's analysis suggests that a similar process may now be underway, with the clock already running. Importantly, this does not require gold to weaken. In fact, Oliver is constructive on gold's trajectory as well, arguing that the metal has historically delivered eightfold advances from major bear market lows. A repeat of that behavior would place gold far higher than current levels, creating even greater room for silver to outperform on a percentage basis. In such environments, silver's dual identity, both monetary metal and industrial input, tends to amplify price movement rather than restrain it. Beyond technical structure, the broader precious metals landscape continues to tighten. Industrial demand for silver has exceeded supply for multiple consecutive years, while production remains largely unresponsive due to silver's dependence on base metal mining. At the same time, monetary stress, sovereign debt expansion, and declining confidence in fiat systems continue to underpin investment demand for tangible assets. These forces do not operate independently, they reinforce one another. Taken together, Oliver's outlook paints a picture of a market approaching an inflection point, not defined by daily volatility, but by long-term positioning. His expectation of silver reaching $200, $300, or even $500 is not framed as fantasy, but as a mathematical and historical response to decades of suppression, mispricing, and delayed adjustment. Whether the move ultimately reaches the upper end of that range or not, his analysis suggests that two-digit silver may not remain available for very long. If you found this breakdown valuable, make sure to like the video, subscribe for continued in-depth macro and precious metals analysis, and share your thoughts in the comments below. Thank you for watching, and as always, stay informed, stay patient, and stay positioned for what lies ahead.